think it was on mute. Hold on.
All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither World.com, CSW, nor its affiliates, nor any of the respective officers.
You are now muted.
Agents or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, here we go. It's a down day. Can you believe it? When is the last time we saw this? It's crazy. Last week we were up here like 15. I was upset because we had so many shorts. So I finally got out of all that, which I never wanted to be that heavy in the shorts anyway. And at this point, I'm just thrilled to be even. What's this? Oh yeah, I was playing the Dow short. I cashed everything ahead of the webinar, so I want to have a clean plate. Here's some TS. Here's some Dow. So a couple of thousand. Made some oil money. What else do we make money on today? RB? Nope, had a loss of the day on. Oh, well, it's a loss, yeah. Once you cash them out, oh, I see. It's the one contract left. That's right. I got out of the other one. This contract has a loss. It's the last in, first out kind of thing. I was very happy that I dipped to 170. In fact, we had a conversation about that this morning, about bringing the average up to 170, and that's, boom, then you get to get out. Actually, that's a good example of how to play the future, so let's talk about that. Who was I talking to? Early conversation. I think it was Latch Daddy. Let's see. Yeah. Let's. This is our PSW chat room, in case you guys don't know. Well, somewhere I thought he asked that. Oh, here he is. He was a reverse question. So you see, he has 3 short of 168 and said, what time DIA report? So what I said to him was that obviously before 10:30, RB shot back up before I had a chance to lighten up. That was my own position. I also had shorts, so I was at 172 average. If I were 3 short of 168, I'd go 3 more 172 and average 170 with very tight stops at 170. So in other words, this discussion was from what time? From 10 a.m. So at 10 a.m., actually, where did we get 172? I don't know, whatever. At 10 a.m., we were up here. So the point was to add 3 more up here with tight stops. So you could have gone here or here and, just keep the stop. And if it goes over, you get out. And then when it comes back under, you get back in. But either way, it raises your basis from 168 to 170 because you had 3 at 168 and you had 3 at 172 or higher. It raises your basis to average 170. And then you can expect reasonably that there'll be a pullback that gets you even, which is exactly what just happened here. It is unreasonable to expect that you're going to get a 5-cent move down in gasoline in one day. So if you're in at 168 and the stock's up at 172, you're not very likely to make your money. Not that day. So unless you plan on sleeping on it another day, and risking, the best thing you can do is really to just, you don't have to do it long term. It's a short term thing. So when he asked, when I was answering him at 10 o'clock, I thought it was 172, it was 173. But the point's the same though. You double down, it brings your average up. In this case, it would have brought it up to 171.5, which would have been great. And then you keep a tight stop. So let's say he had it here. Even if The point was, I said to get out before inventory also. Remember I said that, right? And hope to pick up a dip into inventory. Here's the dip into inventory. So I said, double down here at 10 o'clock, take the dip into inventory, get out. So this would have worked out perfectly if you followed it. And then you can get back in. And after inventories, you can get back in and short again. And then he's raised. So what he's done is he's lowered his average by whatever this drop is. So it's like 0.5%, let's say. So he's lowered his average. Raised his average for the short. He's raised his average to 168.5 here. And then after the inventories, after it spikes up to 174, and we talked about that too, after the spike up, then you can short again with a little more conviction because at least now you know what inventory is doing. And then you get back in with a much higher basis, and then you can actually get out with almost a profit at this point. And that's what you got to do. You got to scale in and scale out. And if you can't do that, if you don't have a big account and you can't afford the risk of doing it, I'm not suggesting you should do it if you can't afford it. And when I say afford it, I mean like the difference between whether my kids and I go to sushi tonight or whether we go to McDonald's. If we're going to spend, we're going to spend $200 on dinner tonight. So, so if I lose $1,000, I'll make it up by not having a couple of, we won't go out to a couple of nice dinners. We won't go see a show. We won't go see a Broadway show. That's what I mean by nothing life-changing. I mean, it's like weekend-changing money you should be playing with, not life-changing money. So when I say afford it, that's what I mean by afford it. Like it's not going to impact you in the least. So if you can afford it, then scaling in is the best way to play. But it's also tricky. You'll lose plenty of money trying to learn it. But it's a great way to play because these things never go up in a never. They rarely go up in a straight line. I mean, just last week, I was down about $20,000 on the Russell. But I planned on being that down. We talked about that last week. I said I want to be heavily, heavily short the Russell when it finally fails. So I planned on keep adding and adding and adding. So it was within my tolerance level to get out. Now, what actually happened, though, is Russell was so freaking annoying. Where is it? Here. The Russell was so annoying and so persistently going up. What the hell is that? Oh, that's it's funny when you look at it in the perspective that you're not expecting. It's weekly. And weekly, it's like, wow, it's like that. But in the hourly from last week, what's today, 25th? So 18th was last Wednesday, is that right? So we were talking about here, and it was peaking out here, and I was very, very frustrated. Then we got our dip, which was great. I was able to get out. Then we got up again, and then I got out again. So the point was I expected a dip, and I just kept plowing money into the thing. Finally got it. That was great. God, I'm not stupid. I took that money and ran. And then when it went back up again, I started shorting it again, and we had that dip the other day, and I took it. And then today I had a smaller play. From yesterday, I had a smaller play, and I took that money and ran. But I took that money right here at $14.95 because I thought it was going to bounce again off $14.95. In fact, I even flipped long at that line and lost the money along the way. But the point is, you play a range until it breaks. And I wanted to be, as we discussed last week, it was ugly because it just so happened, here's the webinar. Just so happened right during the webinar, it was the worst possible time to be talking about it. But just at that time, I had a huge amount of Russell shorts, but I made a huge amount of money on the next day. And again, though, this is within the context of it being a reasonable bet in percentage of the amount that I'm playing. You've always got to keep that in perspective. You should never have any single bet that can really hurt you. And to my point was, if you can't afford to scale in and scale out, then you must play with tight stops. You must play with tight stops. And what's the difference? Tight stops would be, okay, I'm going to short the Russell anytime it's above 15.10. So I'm going to short it with tight stops. So I'm going to short it here. These would all stop out. And when it stopped out, I wish I could zoom this. Oh, I can zoom in a bit. Hang on. I'm smart. I am smart. All right, here we go. Look. All right. So you're shorting at the 15.10 line. You don't short when it's going up. You short when it's coming back down. So here, no shorting. Here, it did go below. And it's weird because I say, well, meanwhile, you could have made money there. It's a matter of question. But here, spiking out, definitely stopping out, and here. So if you're taking quick losses, like a Russell contract is $5 per tenth of a cent. So if you're taking half a point losses, that's going to cost you $25, or because $50 a point, so it's going to cost you $25 each time you're wrong. So let's say 3 of these were losers for 25 because they spiked you up. But then you get a winner, and the winner is the winner is $25, but it never stops you out over here. So you come back, so it stays down, and it goes down to here, and now you're up. I gotta figure out what this number is. It's 5 points. Yeah, so this is 5 points. So these were never 5 points. These are only 2 points. So you're losing 15. Well, shoot. You're losing $15. No, wait. 5 full points. Sorry, 5 full points is $50 per full point per tenth. So yeah, I'm sorry. So your losses would be you're taking $50 losses when you're half point over, you get out, or at least 1 point over, and you take a $50 loss. So let's say you lose $150 here, but here you get a 4 point drop. That's $200 back. So by playing with tight stops, you're $50 ahead with one contract. Then you wait and wait and wait and wait and wait, and now you say, "Damn it! I wish I would have." I wish I wouldn't have stopped out on this one. You wait and wait and wait and wait and wait, and now boom, we're back to our target. So you have one failed shot at shorting, but then the next one is successful. And it's not even a stop out, really. You wouldn't stop out on that kind of thing. So the next one is a success, actually. It goes over and comes back down, stays down. Now you're good. So you're good for another, maybe $100 here. Is let's say it's $100. Then you stop out again. You're waiting. It comes back over. And the one going over is not the one you short. You short the one when it comes back down. So it comes back down to here. None of these would have stopped you out. They're too small. And then you get, boom, a 500-point drop, $500 drop. Sorry, $500 drop. Nope, wait, I'm wrong again. $250 because it's $50 times 5 points is $250. So I'm sorry. So this drop is $250. Then you wait. You get back in. Another $100 and something drop. Wait. Now, if you have balls, you go out. When it's up here, we can kind of start shorting also up by 15. And in fact, I said the other day, I said, well, you got to short below 50. You got to short 15.14 because you're not making it to 15.15. But that's a good sign. That's a good sign. It's not as bullish as you think. Anyway, so if you caught anything around here, that's a huge drop. That's a $500 drop easily. And then you back up. Now you're not getting it. Nothing. Getting it. And now look at this drop. That's $750. And then you wait. It blasted through 15.10, so you're not shorting here. You wait. You either come in here or you don't. Doesn't matter really. But here's your next opportunity. Success. Then you wait. And here, not really successful. More likely a failure if you get stuck here. So that's a stop out. But you notice how if you're using stops, you're going to stop out, you're going to lose $50 a couple of times, but you're making hundreds. And frankly, if I had the time to sit there and stare at the screen all day, I would probably play with stocks, but I don't. I'm always writing. I missed the chance to get out of gasoline. So it's a little too much. Yeah, okay. So I missed the chance to get out of gasoline this morning because 5-minute chart. I added more here on the spike, and when we had the API report, I added more. So I had a pretty high average. I was like 172 something. Then at 5 a.m. it came down below my 172 target, but I started working, and I wasn't paying attention. And the next time I looked, it was back over it was back near 174, and I was like, son of a bitch. So I had it here. I could have lightened up here, and if I had lightened up here like I was supposed to, then I could have doubled down again over here. I would have made so much more money. But as it is, I was pissed that I got stuck in it, but I didn't change anything. I stuck with it, and it all worked out in the end on the big drop. So my way works, but my way is more, I play my way because my way is I can't watch it all the time. I'm able to take a substantial loss what anybody would consider a substantial loss. I'm willing to lose a few $1,000 here and there. So it's like, because I know along the way I'll make it back. Like Monday, we had a heck of a day. Monday, we made like $4,000, and today it's like a $3,000 day. So, it's like, as long as you keep your losses under a couple of thousand, you're not going to get hurt too badly. All right. Do you like TS short at 1,500? Now it's getting, I like things short when they are demonstrably too high. And again, we go back to the channel. And keep in mind, I always feel funny talking about it sometimes. I'm not a TA person at all, but the way I do it is I look at it and say, look, I think the market is weak. Therefore, I'm looking for shorting resistance on the chart. So the first reason I'm in this thing in the first place is not just because it hits a chart resistance. I'm looking to see who's hitting resistance because I want to be short on the indexes. So because I think the market is toppy, I'm looking for places to short. So then I see who's behaving well in the channel. And what happened a couple of weeks ago is I said the Russell is the most likely to fail since it was sort of like above the others. In fact, if we look at Jean-Luc's he writes that big chart. Here you go. So you can see the Russell had taken off like a beast of a rocket. That's a 10% move up for the Russell. The Dow the Dow is now up 10% also. The Dow is also out of control. The NASDAQ though is up 7.5%. Not the NASDAQ. The S&P is up 7.5%. The NASDAQ, and we're just talking about in this period, and the NASDAQ is barely up 10%. The NYSE you can't play, so it doesn't matter, but they're up about the same as the Russell, about 10%. So the 10% move also is attractive to me because it's the 5% rule, and not only is it 10% move the 5% rule, but on the big chart, it's showing you exactly hitting resistance and failing. So that means this spot right here, which is 1510, is that right? 1512, sorry. 1512 on the Russell is the best place to short. It's a fantastic resistance line. Nobody else is in a good resistance line. And that's what makes it attractive to short. So then I zoom into the charts. So where is this starting? This is starting mid-September, late September. So now we zoom into the Russell. I don't go back to September here, but we'll look here. And I'm confirming that, it's a little tricky here. But you can see we go up to 1512 and fail. So now I zoom in more and I say, okay, I know this line here, 1512. And you see how it's being obeyed? That invisible line is the big chart line. That's that 5% rule kicking in right there. So all these little spikes are basically failing at 1512. So that would have been actually the perfect entry if you just use a big chart for your entries, because that's exactly, you would never stop out. There were no stop outs at a 1512 entry. They were all perfect. So 1510 wasn't the right line. It was 1512 was the right line to play. I was playing 1515, so I'm surprised. What I was doing is I was playing 1515, and when it got close to 1515, like over 1512, I just immediately grabbed the short because I was going to have conviction at 1515 anyway. I knew this would not make me stop out. This would make me double down. Anyway, so you're in a channel, and then you have to say, okay, well, what's the channel looking like? Well, it only goes down from 1515 at the top to like 1505 at the bottom, maybe 1500. Now, I don't care how low it goes. I care how high it goes. But also I have to be realistic. I say, well, most of these moves are 5-point, 10-point drops. So that's another part of playing is you have to have reasonable expectations. I have to say, well, that means if I get a 5 or 10-point drop, I'm going to take the money and run. And if you do that and get back to a clean spot, and especially when you, I'm going to show this. There you go. So when you're in it and it's falling and you're expecting a 5-point drop, here's a 5-point drop. It blew past the 5-point drop And at that point, you can use the 5% rule and say, well, if I don't get a 1-point bounce, then it's still weak. So I'm going to set my stop after 1496 because I got my 5-point drop, and I know that if there's not a 1-point bounce, it's weak. And that's exactly what happened. You got multiple failures before a 1-point bounce. That's weak. It's a sign it's going to fall further. All this is just the 5% rule. You get another 5-point drop. So now how much is a weak bounce? Now a weak bounce is 2 points. So you reset your expectations for a 2-point bounce. You get this bounce of 2 points. It's just, it's not quite 2.5. It really is 2 points. So you get these 2-point bounces. Maybe you stay in, maybe you don't. If you get out, there's no shame in it. But you could get out, and then you could get back in when it crosses under again. But either way. So you're getting out. Then you get another 5-point drop, and then a bonus little drop here. But you can see where you're hitting the resistance. You can feel it on the way down because you're going down, but then you get this little spike up, and then the next line goes down and spikes back up, and the next one comes back up. You can feel it. The momentum is getting lost. And that's, by the way, another really good reason to use the 5% rule is it takes the emotion out of the trade. Then you've got a hard number, and you say, okay, I know what I'm expecting. And expectations are key. See, a lot of people trade. They don't have a real goal or an expectation. And if you don't have that, then greed starts taking over, and you don't know where to take your money off the table. Like, I'm trying to think of a good example of that. Well, it's like a football play. Let's put it that way. It's like in a football play, I'm a quarterback, and I'm going to throw the ball to the receiver, and the receiver's going to catch the ball. But if he catches the ball and he always thinks he's going to turn around and run for a touchdown, he's going to drop the ball more often. He's going to blow his off. Even though I threw it right to him, he's going to drop the ball more often because he's not thinking of catching the ball and covering himself and making sure he can take a hit. He's thinking of how am I going to spin around and be ready to run. And that's two totally different ways of playing. And it's the receiver who's going to get the opportunity to catch the ball has got to have a realistic expectation of what he will do with the ball once he's there. Will he be satisfied with the yardage we've gained at the spot he catches the ball? Or will he try to run? Or will he try to spin for a couple of yards? Or will, different ways to play it. But point being that it's very easy, and this is a big mistake high school receivers make all the time because they always want the glory. They caught the ball, and with a receiver, you might only catch a few, 2-3 balls a game. And all the kids, they dream of that touchdown, right? It's not about, this is why the coaches have to drill into you, it's not about you getting a touchdown, it's about your team advancing the ball down the field. And your portfolio is like that too. You've got to advance your portfolio down the field. You've got to grind out those wins. And they don't have to be big wins. They have to be lots of little wins that add bulk to your portfolio and push it and make it larger and let it grow. That's the way you have to do your portfolio. It's a yardage game. You need to grind it out. You have to take those small wins and let them add up and accumulate. And your portfolio gets bigger and stronger and more powerful as it goes forward. But it never will if you're constantly like, every time you try to go for like a touchdown. It's not going to work because you'll end up blowing more plays than you make. And it's not to say you won't occasionally get the touchdown because you will, but then the next 5 plays you blow it because you want another touchdown. It's not the way to play. You want to just grind out the yards consistently. That's how you become a winner. All right. So any questions on that? Maybe a trade setting up in T. Now, we just talked about that today. Let's take a look at AT&T. T. There we go. Wait a minute. I changed this to me. Logging. Oh, now you know me. What? Your account is expired? It does not. Oh, man. All right, so much for that. All right, back to T. That's embarrassing. I'm using it on my other computer. Yeah, totally working. All right, sorry about that. Don't know why. Yep. Can look up stuff and everything. Weird. So where was I? Oh, tea, right? Okay. So what did we say about tea this morning? I forgot. I said let it simmer. Yeah. That's what we expected. We didn't think they'd have a good quarter. They got you know what's an interesting play though? Verizon. When's Verizon's earnings? They won't be hurt as badly as AT&T was because they sold off Texas and Florida. They sold it to Frontier, who are getting killed. Verizon had their earnings already. Damn it. When did Verizon report? A lot of news on Verizon. Verizon sees substantial boost in wireless customers. I don't know. I missed their earnings. Oh well. Anyway, so that was interesting because Verizon, since they sold the hurricane damaged states to Frontier, they wouldn't have the same kind of cost hit that AT&T did. And you can see they're holding up way better than AT&T. So there's several problems for AT&T. They have the damage they have to repair to their systems. And all the phone companies have a problem with the changing environment, like the on-demand. Everybody's watching TV, and everyone's getting rid of their home phones. Kids can't even imagine why there's a home phone. I just had a conversation with somebody I was talking to, and I said I don't think I'm going to get another home phone after this. I said I said when I move, I said I can't imagine why I would get a home phone. There's not really a reason for it. I mean, but 90% of the time it annoys me with telemarketing. I mean, literally, I'd say 4 out of 5 calls are telemarketing calls on that line. On the house line, not my office line. At least nobody's got that yet. But you can't have, you give out your phone number. That's what happens. It's such a pain in the ass. So, anyway, so they're dealing with a change. There's a lot of stuff happening. There's a lot of competition from every side. You've got Sprint and T-Mobile merging. So as much as I like them here, and it's certainly attractive, and you could certainly initiate a trade, I'd rather wait and see what happens. I'd rather give them a week at least and see if are they going to stabilize here, or maybe they'll go to 30. If you're lucky, they'll go to 30, and then they're a fantastic buy. I mean, there's certainly value there. It's just a question of whether or not it's worth doing. And if we look at their option chain, obviously we wouldn't pay 30 anyway, but even at 33, you can sell the $30 puts for $3. So that's a 20% discount to the current position. You would net in for $27. And you're getting another 20% off the current price, 20-something percent, 23% off the current price. And that's good. Now, I would be happier, and it's greedy, because, I mean, honestly, I only expect them to drop $3 more at the most. And the most I'm going to get is probably where the 33s are, about $4.50. So really, I'm being cheap where I want $150 more than what they're offering. So that's my goal. My goal would be to sell the 30s for $4.50. But here's the trick. If they turn out they hold 33 and they go back to 33, let's say they go back over 34. Well, if they go back over 34, I would certainly consider selling the 33s for $4. So I'm still going to get more than $3. And I'm going to sell these, but I sell them after I know AT&T has stabilized, after all the bad news is run through the ringer. So I don't see, so to me there's no negative. In other words, I don't mind getting a slightly higher strike if I'm sure that the damage is done and it's over. Right now, I'm not sure. So right now, I might buy these for $3. Sell these for $3, and then next week they're $4.50. I'm down $1.50. And again, I don't really care that I'm down $1.50. It's just a paper loss, and I have no worries about getting AT&T for $27. But why should I? I would be so much happier. So, in other words, my unhappiness about missing out is much less than my happiness would be if I get a break and it goes down. I'll be so thrilled and so happy with that position. I'll probably take a much bigger position if it's $4 or more for the 30s. So that would be, so for me that's a big win because I would be very happy. I'd want to commit more money, so on and so forth. And it's always good to give it a few days because let other people read the reports and comment on the reports and talk about the direction of the company. Read up on the conference call, see what they have to say. Don't just jump in just because they're down. I know they're a good stock and they're down, and I absolutely agree it's an opportunity. But when somebody drops 4% in a day, they probably have a little more gas in the tank on the downside. That's a big move for one day for a major stock. Now, of course, in this crazy market, we get those kind of moves all the time. No more free rides. Any chance CHK will turn around at some point? You still like them? I like them as a long-term play because I like natural gas long-term. They have really, though, the new management is nowhere near as good as the old management was. Aubrey, he's dead. Under mysterious circumstances, too. But he was a genius. And I didn't think that they would unravel as badly as they did, but they really have screwed up. That being said, though, so I'm not happy with them. I don't have a huge amount of faith, but we do have a play. What's that play on CHK? Let me see. Walk into that one. Well, that one likes me. Okay. All right. So what do we have on CHK? Ooh. Hey, there we go. Oh. So we have the $5 puts, but we sold them for $120. So $3.80 is our buying. And we have the $2 calls. So neither one of these is doing very well right now. We have a lot of them. We have 100. And we did not sell calls against them because we were hoping they would bounce, but they did not. Although we were hoping that, a month ago, and it's still in the same place. So it's actually our fault because we should have taken, when it went up to $4.50, we should have sold calls then. That was just a mistake. So that's what we were waiting for, to pop like that to sell the calls to cover. Anyway, I think this is a good range. I think if you look at the numbers on these guys, let's see, CHK. I mean, the market cap is just $3 billion right now. They keep selling off assets to pay off debt, so it depends on what, it's going to be a smaller operation. Revenues were down to $7 billion. Now they're creeping back up to 9 or 10 billion. All right, and they're making money. They're losing money. So they look ugly going backward, but going forward, you're talking about $1 billion profit. $1 billion profit for a company that you can buy for $3 billion is good. It's just, everybody looks at these things. They see this. This is what they see. They look at a thing and they see, minus 33.8, and they look at the financials and they say, oh my God, they lost $4 billion last year. But they don't take the time to just go like this and say quarterly, quarterly they're making $500 million now. They took all of this. And also, what people don't understand is that when you see this and you've got a turnaround, these guys aren't going to pay taxes for the next decade. So you're going to get $1 billion tax-free. You're going to get a 33% return on your capital tax-free from this stock. That's what I like about it. It's not my fault if other people don't see it. But they divested all their crap. They paid down their debt. They got their house in order, and they're running a smaller, leaner, meaner company now. And again, like I said, the way they handled it was iffy. But on the other hand, maybe they didn't handle it badly. Because you know what? If Aubrey was still there and he was doing this, I'd say, well, yeah, he's just doing it so he can buy the stock cheap. He would do that. He would tank the stock and then make everybody think it was something wrong. And then he would buy it all up. And then he would do something brilliant and then turn it around. It's like the history of his company. Oh, yeah, let's see. I bet we can do a Yahoo. How do you do chart in this thing now? Oh, they changed all the. So where is their long-term max? So look at this thing over time. Well, this is not really max, but they were king of the hill back here. They go down, they go up, they go down, they go up, they go down, they go up, and then now they've been in a prolonged downturn. So this has been going on for ages. And they've cleaned house. They've changed the nature of their company. They've made it a much smaller, much easier to manage company. So I'm still interested, yes, for sure. I still like them. Ooh, that's a cool feature. Wow, look at that. So I roll my mouse and it changes the range. Love this new web stuff. I wish I just, I wish I knew how to make it. You know, I wish I knew enough to get it to work on other things. It's crazy. Silver's cheap. That's a good buy. So yeah, I still like CHK. In fact, let's take a look at a new trade. You know, our trade, it's not blown, but it's very aggressive, and it's based on the fact that I think the natural gas will come back one day, and it'll be a big boom for them. At 355, you can buy the what are these 150s? Yeah, I would do that. Okay. No, 2. Yeah, 2. You can buy the $2 calls for like $2.10 here, maybe $2 even. Let's say $2.10. You buy these guys for $2.10, the $2 calls. You sell the 450 call for 90. It says 90 cents. So 90 cents. So 110 minus 90 is wait, what? No, 210. I was going to say that's too cheap. So it's 120. So you're paying $1.20 for the 250 spread. And then you could sell like these $3 puts for 80 cents or 85 cents. And your net is what, like 20, 35 cents. So you net 35 cents into a $2.50 spread. So that would be the $2 450 spread for what we say 90, 110 minus 90 is 120, 210. So 120 on this spread for the $2 450 spread, and you know what? You're going to get 250 back. That's $1.30. It's 100% profit. You can just leave it at that. You don't have to sell puts. You know, maybe only sell puts if it gets worse. Because it's like I do that a lot. It's like I want to construct a trade with a short put because I think it's a good floor, and I'm happy to be involved in the stock at that price. But in reality, if you're not sure that you want to own them, then don't. You're going to make 110% if it goes well. That's on just the bull call spread. All this short puts do is enhance that return, but but the hassle if it goes down is that you have to deal with owning CHK. But in this case, like I said, I'm happy to own them for the net of this, which is 85 cents minus 3. So for $2.15, I don't mind owning them. So I'm happy to sell these. To me, it's like free money. So if I see a Porsche for $80,000, and somebody says, "I'll give you $5,000 if you promise to buy it for $60,000," I'm like, sure. Why would I not do that? I want the car. I like it. And if it goes lower, I would be happy to buy it. So that's how it works with a put, right? I like the stock. I don't love it, but I like it at this price. But at $3 minus 85 cents at $2.15, then I really like it. I like it a lot more than I like it at $3.50. So for me, that's like giving me free money, even at $3 a strike. That's why it's free money. It's like I'm happy to buy it at $3. If it goes 50 cents down from here, I'm happy to have some more position. So that means the 85 cents I'm collecting is free money. Then I apply it to my bold call spread. But you have to really want to own it, and you have to have room in your portfolio for it. You can't just do it to mess around. You are obligating yourself to buy the stock. And not only that, though, but the only reason you'd be buying the stock for that price is because something bad happened. So after something bad happens, then you're obligating yourself to buy the stock. Always keep that in mind when you're selling puts. But nonetheless, that's how I would play it. I would do that because your cash out of pocket on the trade is nothing. It's 35 cents, and you get a $2.50 return. And look, the margin. This is the thing. If you have this is ordinary margin. This is not portfolio margin. This is just my futures account. Sell, single, and I'm going to sell them for 85 cents. And what does it come out to? Look, the buying power is $3.89. So it's really margin efficient. I'm collecting $8.50, and I'm using $3.89 at buying power. That's what I mean by free. It's like, why would you turn that down? So that's what I'm saying. When you're in a portfolio where you have plenty of margin, you have a lot of spare capacity, you have nothing, you don't need I would rather have the cash than have the margin sitting around, collecting dust. So I'm going to, in times like that, I'm going to see, like, sure, I'm going to reduce 75% of the cost of the trade by selling some puts. That makes sense. Can you discuss the long-term strategy for GM trade and long-term portfolio short calls and puts only? It's not a long-term. It's in the long-term portfolio, but it's not a long-term strategy. With GM. Boy, we got a lot of positions. Here you go. So with GM, we sold these calls. I haven't done any of the adjustments yet. Thank God we did too. These were like $18. We sold these calls for $18. They're already down to $16.28. And we rolled these short calls up to the 45. So all I was saying, we spent a little bit of money to roll those up to the 45. I don't know when we did that. Was it Friday? Must have been Friday. I'll show you what the trade thing looked like. Monday, Friday. And I'll tell you what the logic was also. We'll talk about that. EN. And again, the huge value to being a value investor is not just that we know when something is cheap. It's that we know when something is expensive too. So when GM was down here, we bought it. When GM was up here, 30% later, we sold it. Because we know what enough is. Same with the same. It goes back to that football player, right? We caught the ball. We made our catch. We got exactly what we expected out of it. Our target on the trade. This is another reason I like to sell calls. We had a $35 target. It blew over our $35 target. That's a year from now, a $35 target. Now, I'm always conservative with my targets. I know that. But still, when something is 30% over your target, probably it's too high. I don't set my targets like crazy low. I might set them low, like GNC. GNC, we have a very low target. The target is half of where it was when we bought the stock. So no, we bought the stock for like almost $10, and our target is $5. Which is hard to even say why that's a bullish play, but it is. It's a bullish play because we don't think they're going to go bankrupt. We're more bullish than the people who are betting on it. But in GM's case, so there's factors. But in GM's case, I know I don't think there's anything wrong with the company. I know I think they're strong. So I set a target. If I really thought they were going to be in the 40s, I would have played the 40s. But I didn't. I wasn't that confident. Because there's plenty of headwinds moving on a year from now. Not this year. Moving on. It's a long-term investment. There are headwinds that I wasn't willing to risk. So we took a very simple play that made a fortune, made $40,000. So we had the 28-35 spread. And GM blew through it. And so what I said is, we're so far over target that we have to do the math. $35,000 is the max payoff. We're currently at $28,555, so 25 cents more to gain is kind of dull. GM is toppy, so let's do this. Let's cash in the 28 calls. Where did they go? Okay. So the 28 calls, we cash them in. They were $18 at the time we were doing that. And we took, instead of taking $28,000 off the table, we took $90,000 off the table. That is $60,000 more dollars than we planned to make on the trade. No, not that we planned to, sorry, we planned to make 35. So it's still around 55,000 more dollars. So it's 55,000, 150% more money than we planned to make. So it's, which is 11 more than the spread plays. So, and 11 times 50 is 55,000. Wow, very good. All right, so with the extra 55,000, oh, there, I did the math too. Boy, I am good. I like that. Everything is funny how consistent I am, right? Because in my head, I'm doing exactly what I ended up writing. We can roll it. Maybe if I read ahead before I talk, it would be better. We can roll the short 35 bucks. So now, I'm sitting on $55,000, but I don't like the risk of having the in-the-money 35 short call. So what do? I take some of my $35,000, of my $55,000, and we roll the short 35 calls to the 45 calls at 505. So we spent $6 times 50, which is 30,000. Well, what's that much? Wait, 30. No, yeah, we spent about $30,000 of our bonus 55 to roll the short calls from the 35. Wait, 35 is way down here. From the 35 to the 45. So I paid $6 to make a $10 roll. But I feel there's a very, very strong likelihood that those will expire worthless. And if they don't, I can always reestablish a 20/20 spread to cover. So I said, because what's our goal? What is always our goal? Our goal is to sell premium. And what happened when I moved them to $45? They were 100% premium. Premium always expires, even when it goes in the money. I sold the $35 call. The reason we're in such good shape on the spread is because the premium, even though they're deep in the money, their premium that I originally sold them for, which was $360, that expired. It went away. I have to pay them back $10 to get rid of them, but I collected $360. So my net on this thing, my net loss, is only $7. And I take, instead of paying the $7 loss, I pay $6 to roll them higher. And I'm not taking the $360 out of my pocket. So I saved all that money, and that's still in my pocket for this place. Still have $25,000 or whatever it is left. The puts are obviously going to go worthless, so we're not worried about those. But I think we beefed up the puts too. What did we do? We can then buy back the short puts for $1 and sell 20 of the 40 puts for $290. So we bought back the $2,000 worth of puts, and we sold $6,000 worth of puts instead. So I've added more money there too. Why? Because the short puts balance out the short calls. Not totally, but they do. Why did I not want to sell more short puts? Because I think it's going to go down. That's my whole premise, is it's going to go down. But just in case it doesn't go down, then that $5,800 is money I can use to roll up my short calls again. So I can't lose on both of them. The short puts and the short calls can't both go in the money. So my theory, so now we have the $40 puts in 2020. So that's how aggressive, that's how bullish I am on GM. I will sell the 2020 $40 puts, because given another year, and I think it'll justify 40 easily. But I don't think it justifies 45 now, and I don't think it's going to justify $45 into next January. I think that's it. I think we hit a peak, and they'll probably consolidate around 40. So that's how we're playing it. And if not, we adjust. And how would we adjust? Well, don't forget, to the downside, nothing hurts us, because to the downside, if they drop back to 32 or 30, well, here's 35. If they drop back to 35, then these puts that I sold for $2.90 will be $5. Where's the harm? I'm not harmed by that. And if that happens, that means these guys are worthless, and we're up like $80,000. So that's not there. Nothing wrong with that. I don't care how much money how much GM stock you make me buy if you're going to give me $80,000 to start. So that's fine. And on the other side, if it goes up, so we're not worried about the downside at all, because we can roll these, we can do all kinds of things anyway. But we're not worried about the downside at all. We are worried about the upside. If it goes blasting higher, then the puts contribute money towards doing a roll. And what would we do? We would cover by buying maybe the 45-60 bull call spread in 2020 to cover. And if GM is blasting above 45 and breaking out to new highs, I want to own the 45-60 spread then. I think it's a little pricey, but I got a gigantic cover. I have a $56,000 cover. No, not 56. Sorry, 25. I have a $25,000 cover. So that's what these guys will still be a cover. I'm not gonna. I refuse to pay them more money, but I will buy a spread that we can then use as a new trade, and that spread can then make 100% on the money we put into that spread. So it's a cycle. It's not one play and you're over. You have to think of the next move and the next move and the next move. As each cycle comes around, you can adjust the trade to reinvigorate it and turn it into something that's going to make you another 50% or another 100%, even though you're taking a loss on a certain part of it. You have to take a loss on a part of it the way we structure these trades, because we're betting against ourselves. It's not that likely that we're going to win on every front. We sold these calls, we sold these puts. One of them is going to be in the money. So we're always going to have a loss. It's pretty rare that we don't have one loss in our position. There should be one red in every position. That's if it's going well. If it's going badly, we have two reds in a position. You can't have three reds. Can't have 3 out of 3 losers. Usually have 2 out of 3 winners. And the winners, and if it all goes well, the winners dwarf the loser. And that's the way we play it. It's statistics, and you don't really even have to be right half the time to do well like this. You just got to learn how to set up the spreads properly. GoGo. Oh, is GoGo down? There's something going on with them. Oh, yeah, they're investing, right? Yes, people hate it when companies. When companies that make money invest money in R&D or infrastructure, they get punished mercilessly, like phone companies and things like that. But if a company makes no money, like Netflix or Amazon, and they spend billions of dollars and throw it down the tubes on R&D, nobody cares. It's the weirdest double standard. So in this case, GoGo is building a very expensive next-level satellite system, and they have long payoffs. So it's a frustrating hold, but it is a good entry. Do we even have them anymore? GoGo. Not built. Not with that many G's. They're not there. We used to have them. We got out. But I think I still have them in the OOP. $300%. That's wacky. Holy cow. GoGo. Yeah. Oh, okay. We do still have them. So we have the May 10-14 spread, which we paid $1.85 for, and now it's down to like $1.20, and we sold a $12 put. So net, we're down about $1,500 on this spread. What we're going to do is adjust it. I don't know if there's really a good roll yet, but we'll stick with them because we think they're going to take off. And this is our second time at GoGo, so we're used to it. I wish they had longer options. No, see, they still only go out to May, so there's no real reason for us to do anything yet. Because May is a long time. I mean, in January, there should be July contracts out, then we'll want to make a move. Well, before January, probably. But when the next, when July's come out, then we'll be, then it'll be worth adjusting. Right now, if you look at it, what were they short to 14? Would I pay 40% out of the money? Would I pay 50 cents just to pull those back? No, that's not worth doing. And then the next question is, do I want to widen the spread? So from 160 here to 280, so it cost me $1.20 to roll them down $2. It's not worth it either. So there's nothing here that I would really want to adjust. And the $12, I'm not worried about these because I'd easily roll those into 2 times the $9. So there's nothing here worrying. As long as they hold 10, there's nothing to be worried about. And frankly, there's just as good a chance this whole trade will go in the money. So it's not worth changing. It's a small entry, which I'm very pleased with. It's a nice small entry. So even though it dropped considerably from where we came in October, where are we? How did I just look at that? That's weird. Did you just look at them? Oh, there it is. So when did we come in? August? October. Oh, we just came in. No, last August. I was going to say, I don't remember doing that. A year ago. That makes more sense. So we came in last October. Oh, and they were right about this price. They were 10 then. So there's been a roller coaster. They went down, they went up, and now they're down again. So the first time we got in was here in that summer. That's why it's the second time. They went down. What happened is we got in them here, we doubled down here, we got out here. Then when they went down here back to 10, we got all excited again that we could get in again, and that's where we are now. So we're stuck. So we have this trade. So if they go down to 850, I'll be doubling down. But as it is now, it's a small entry. Why? Because it's a crazy ass stock. That's why we took a small entry in the first place. If it gets cheaper, then we start saying, this might be fun to double down on. But at 10, it's like, I like them, but I don't love them, unfortunately. It's great. 850 is my banging the table. So I guess the short answer is I bang the table at 850 or 750. Well, let's say at 850, I would be very convinced to start getting into it. But it's a long-term play as far as realizing the value. Until then, it's just a matter of opinion and how people are. Oh, look at the down making. Oh, shit, we should have played that. Comeback. Did you do any new futures? No, I didn't. That's what I just said. ADX earnings. Okay, let's see. Where are they? That's Barrick Gold, ADX. Well, okay, first of all, let's look at gold. Actually, you know what? I'm going to look at it on this other chart, too. That way I can flip back and forth. A metal, not a meat. Okay. I'm like hovering between them. I'm like, why am I not being able to make this decision? Here's the question. Barrick is reporting on the June, July, August sales. So, the question is, and you're not going to see it here, the question is last year, in June, July, and August, in this quarter, we go higher or lower than it is now. It was higher by quite a bit. So we're comparing this here to this. So pretty obviously, the midpoint is 12.50 here, and the midpoint is about 13.50 there. So they got $100 less per ounce this year. than last year. So that's clue number one. So we know that there's pretty much no way they sold enough more gold to justify it. Now, what was their price when they reported last November? They were way down here. That does not bode well for this report. Okay? Now, they probably reduced their costs, but I don't know if they reduced their costs $100 from last year to even out their profit. That's tricky. So, other things being equal, I haven't done a whole huge analysis of each earnings period for them, but other things being equal, I expect this to actually probably dip them tonight. But I like them. I'm not going to bet on that. What I would do is I would hope, and that's a play. Not playing is playing. Not playing is a game. Not moving is a strategic move. So what I would do, as far as this goes, and we already own Barrick Gold, and I think in all of our portfolios we have Barrick Gold, because I love it. But as far as doing a new play, I would hope that they miss or they disappoint somehow. And that will cause them to drop back to here, to the 13, 14 level. It's not far away, 10% drop. So if they come back down and they're below 15, if they're, wherever they settle down, is a good time to get in. But I wouldn't play for them to do that, and I wouldn't go long. So it's generally a no-play stock at this level. All right? But, see, I always get annoyed at people with people who invest in mines. They sit there and talk about all this bullshit, and they don't look at the fundamentals of the metal. I'm like, it doesn't matter. What I care about is, I care about how the company's doing, but they are slaves to the price of gold. If gold's high, they're going to do well. If gold's low, they're not going to do well. It doesn't make them a bad company. When gold, when we were snapping up Barrick down here, and then I was banging my table on these guys every day, and they were like some ridiculously low price. I forget what it was. It was crazy. Look, yeah, $5. I mean, $6, $5. I was like, Barrick! It's like every day. It was like every time we needed a put, I'm like, sell puts in Barrick. It's not their fault that gold was down. This is not their fault. Yet the stock was cut in half or in thirds. All right, and now that it's back up a bit, it's nothing genius that they did. They're just running a mine. They pulled as much gold. They have a bunch of mines. They pull a bunch of gold out of the ground as cheaply as possible, and they sell it for whatever price they get. But the real value in Barrick Gold is the fact that they have 100 million ounces of gold in the mine. So when you're buying them, you're buying 100 million ounces of gold. But, of course, it's not $13 billion. No, wait. 100 million ounces times 1,300. 130 billion? Oh. That's hurting my brain. 1,300 times 100. 130 billion. It is goddamn. So they've got $130 billion worth of gold. All right? And you can buy the whole company for, that's nothing. That would be insane. Still insane. $18 billion, all right? So you can buy $130 billion worth. So if you want gold at a discount, this is how you get it. But it's not about that because that gold's in the ground. So what it is how much is the difference between how much money they get gold out of the ground for, which in Barrick's case is less than $900. That's why I like them. They're the cheapest extractor. They used to have 140 million ounces of gold. They sold off 40 million ounces of gold, paid off all their debts, bought back stock, and they, which is why they might not miss today, because they bought back a lot of stock. And they improved their equipment. So they kept all the cheapest producing mines, sold off the expensive producing mines, and they now have the cheapest operation by miles of any gold miner. Now, why is that important? It's important for a couple of reasons. First of all, at $900, they're making $400 an ounce. So they're going to make $400 million on their, $400 billion at the current price, and you're buying them for $18. Now we're talking, right? That's their net profit out of the ground. And that's at today's price. Now, what if today's price of gold goes up? Every time it goes up another $100, that's another $40 billion they're going to make down the road. So people are valuing this like a regular gold company, which is silly, because they're better than a regular gold company, and they also have more gold. Now, also that cash flow that they get, because they're such a low-cost producer, when gold goes down, you still want to own these guys, because what they're going to do is that's when they buy. They're not stupid. When gold goes up, they sell their worst-producing mines. When gold goes down, they look at their competitors and say, okay, well, who wants to sell us some mines really cheap? And they'll only buy their competitors' best mines. And that's a cycle. You know who else does that? Hovnanian does that with land. That's why I like Hovnanian. They're smart. They take their hits, but they take a hit and they turn it into something. And they say, well, okay, fine. So our land, our land is all worthless. So we're going to actually not push the sales as much. We're going to sit on our land, and we're going to go around to our competition and buy out their land. All the good land that they have to get rid of because they're stuck. People who know how to manage themselves through times of crisis are the best companies to own. But unfortunately, you have to have faith in the management sticking together and sticking with it. But anyway, so I love these guys, and hopefully they miss. So, I love these guys, and hopefully they blow their quarter. The estimates have been steady at 18 cents. Last year, obviously, with the higher price of gold, they made 24 cents a share. People think they're going to make 17 cents a share this quarter. They missed last quarter. Oh, that's estimate, sorry. Earnings history. They didn't miss, sorry. They didn't miss. They beat by 15% last quarter, and they came in at 22. And then again, you look at the price of gold and say, well, if they made 22 last quarter, and last quarter, not last year, if they made 22 here, why are they only going to make 17 here? It's basically the same average cost. Not only that, though, but they're certainly going to guide higher because they had a really nice bump here, and it's been staying up. So the average is improving. All right, so there's the case for the beat. They might beat. So the expectations are kind of stupidly low. So, all right, now, so given that, all right, as an earnings play on Barrick, and again, I'm not saying we should change our stuff because our stuff is fine. If they go down, if they go up, we make money, and if they don't go up, we probably will buy more. But as an earnings play on Barrick, you can go to the 2020s. You can get again, if they do well, they're going to blow higher. So you can take the $15 calls, which is right on the money, for $3.50 or $3.45, whatever it is, so $3.50, let's say, and you can sell the 22s at $7 higher. I wouldn't even do that. Yeah, I would, because it's such a small difference in price. I would. So for $1.30, you can sell these. So we got $3.50 minus $1.30 is $2.20. So you get $2.20 on a $7 spread, and I would sell half the $15 calls for $2.10. So I forget what we said for a number. It was $3.50 minus $1.30, so it's $2.20. So $2.20 minus $1.10, because you sell those for $2.20. So $2.20 minus $1.10. So now you're paying net $1.10 for each $7 spread. So you basically have paid a $1.10 premium to Barrick at $15. Now, if it goes higher, you're good. You're going to be in the money on your $7 spread. You're going to be in fantastic shape for a 5 times return. If it goes down, you only sold a half sale here, and you can either do a 2x roll down to like the 10s or whatever. You can do a 2x roll, or you can just sell more because, frankly, it's going to bounce back anyway. Like I said, I want them to go down, but only so I can get a better price to sell things. So, in fact, more likely than rolling, I'd probably rather just sell more of these because they'll come back to 15. Go in 2 years. Now we're giving 2 years. In 2 years, there will be inflation. Come hell or high water, you'll start seeing inflation, and people are going to run back to gold. So that would be my trade on that one, and it's actually good. It's actually almost in trade of the year territory. Frankly, it's such a strong probability of success. And again, I'm sorry. And the other reason I sold the 15s because why should I spend this money? Because it's either going to go up and we're in the money and it's fine, or if it goes down, it'll be cheap for us to roll to a lower, wider spread. So there's no reason there's no reason to spend an extra $1, whatever, $1.25 here to be $2 lower. That doesn't make any sense because it'll be a much cheaper roll if they miss and go down. Not only that, though, but if they miss and go down, we'll be able to buy back the short calls with a quick profit. We'll be able to roll down here, and then we'll be able to sell more puts and wait. I love those kind of trades. So I know it's weird, but I mean, I go into a trade like that with a small position, hoping that they miss, even though I'm bullish, hoping they miss so that I can get a bigger position at cheaper prices. I don't actually want, even though I bought a bullish play, I still want them to miss. Any thoughts on Tesla? Tesla is look, I don't want to disparage them or anything. I love the concept of Tesla, but they are probably a scam. I know they actually make cars and they try really hard, but they're a scam. They're a scam because their cars cannot make money. They are selling, it doesn't matter how many unprofitable cars you sell, you will never be a successful company. So you're talking about a bullish position. No, you're not. You're talking about a put spread. That's good then. 340, 300. It's such a dangerous stock. I was hoping they'd come back. I'm just out of it now because I was hoping they'd go higher. They haven't gone higher. They keep going down. But this is reality for them. Well, and they're hitting, so they're coming up to this thingy, the 200-day moving average. They're almost certainly going to bounce off that. They've fallen from 380, so 380 to 320 is a $60 fall. That means you're going to get a $12 bounce at least. 20% bounce is going to be back to where it is now, which is that's 320. So they should go back to 330. So right about here, this line here, which is actually forming up, that's your weak bounce line. And then 340, like 345-ish, that is your strong bounce line. Back to the 50-day moving average. So, for me, I wouldn't do anything here because there's very, very high likelihood that they're going to bounce higher than this, even if something bad happens. Buyers are going to come in here and think they're getting a bargain, and they'll drive the stock back up. No matter what sins this guy's committed, people seem to be willing to overlook them. When it's up here, I was waiting for 380s. I don't think it's ever going to happen again. But when it comes back to here, I'm going to jump into the play also. But there's nothing wrong with your play. I don't disagree with it. I'm personally, I don't get excited about buying. I don't get excited about getting into a play when it's already down, like almost 20%. It's hard for me to do trades like that because it's like it's already down 20%. What do you expect it to do? And I agree. I mean, if you're happy to deal with it and roll it and then adjust it if you have to, then fine. There's nothing wrong with that. Selling 360 calls. January, really? So January 360 for 12? Oh man, these people are crazy. Well, now you're making me want to do it. The stock's at 320. Can't be this January. Oh my God, it is. Wow. Wow. That's just nuts. That is, look, it's 86 days away, and they have to go up, not 20%, they have to go up like 15% just to get there. But the break even is 372. That's like $50 away. It's almost a 20% gain just for them to get even, and then you can roll them. Oh, that's like free money. Holy crap! Wow. Wow. I'm just blown away that people are that stupid. Who the hell would pay this? Okay. I like your trade because of the anchor's great. Wow. That's a ridiculous amount of money. I'm pissed off. I really should have gone in that before. Oh, look, everybody's bubbling up. Look at that. And I didn't get in. Did I leave anything working? I don't think I did. No, because we talked about that before, right? See, I put out a note to the members, though. I told them it's a good time to play £4. It was. Did I do that? Click here. Didn't say the word bounce. Yes, sir. Oh, flip long on TF, yeah. So at 1482.50, which was basically the dead bottom, that's pretty good. What time is this? 11:30. Look at that. Nailed it. At 11:28, flip long on TF, tied it having it reverse, and I popped up. I cashed that. When it did that, well, I guess it's okay. I didn't get back in though. That's the problem. I planned on getting back in for the webinar, but of course we got sidetracked. So we'll see. Well, I like these guys. I like AOK. I wouldn't jump on them today, but wow, look at that. They had profit. They have revenues. They bought Virgin. They bought Virgin America. So they're into a restructuring thing. It's going to take some time to work it out. It's a great airline. Definitely worth having. So Twitter earnings play, no. I say no to Twitter. Who the hell knows what they're going to say? It's like a completely random thing. You know, they're at a price. I mean, I certainly like them down here. I can't get away from the numbers. It's like they just have too many users, and they're poking and poking and poking. And they'll figure out a way to shake some money out of those people. So, I mean, everyone, well, not everyone, but most of these social media guys do, because even Groupon just made money. So, look at Groupon today. Let's see. Well, it's ERPN. I'm surprised that Twitter is not popping just based on that, because even Groupon. Oh, no, look. Oh, Groupon didn't go up. They had a really nice earnings report, too. That's weird. Somebody's selling off the social media side, then. Anyway, so that's the Twitter. I like Twitter. I like them long. I think we have a long play on Twitter. I just don't particularly think that this is, there's no way to guess what this earnings is going to do. So if you want to construct one, I bet they probably have nice launches. I can't believe the price on these Tesla contracts though. I'm going to take a closer look at that and see if we can put something together on that. Twitter. That's just stupid pricing. In fact, hang on, let me go back to that in a minute. That's something funny. All right, so Twitter. They don't go out to 2020. So they only have these. You can sell $15 puts for $165. That's like a gift because that nets you in for like 12 something. Not 12 something, 13 something. And let's see, 15. So these are 415. These are 540. So would I pay $1.30 to be $2 lower? No, I would not. And here, to be $2 higher, I don't want to be out of the money. So definitely these. So the 15s at 420 or 415. So 415, and then you could sell the 25s. Oh, that's a nice wide spread. So you can sell the 25 for $1. So the 15-25 spread for $3.25, and then sell these guys for $1.65 is $3.25 minus $1.65 is God knows what, but some number like $2.60. I think it's $1.60. So yeah, you get $1.60 on a $10 spread. That's the way I go. So basically, the Twitter 15-25 bull call spread for $3.25ish or whatever I said, and then you sell these guys for $1.65, and $3.25 minus $1.65 is 20 minus 60 is 60, right? Yeah, so it's $1.60. Wow, that's a good price. So yeah, that's compelling because you're in it for $1. You're in it you're in it. Your net from 15 to 1 at plus 165 is 1665, which is lower than it is now. So you catch every single penny of upside, and if it goes down a bit, who cares? If it goes down 10%, it's not going to hurt you. So that one I definitely like. See, so even though I don't like the idea of playing it, it's just sometimes. Oh yeah, I was just going to say on the other one, Tesla. Sometimes there are just compelling options that you're like, well, why shouldn't I play that? That's good money. You guys have no idea. Ever since we've been doing these webinars, you don't even know what it's like when the VIX is high. When you're in a volatile environment and you're getting double what we're talking about for these options, this thing is like a gold mine. These are terrible times to be selling options because the VIX is so low. I was just going to say, okay, so you got to 2019. Look at this. You can sell the Tesla $500 calls for $13.50, and you can sell the $200 puts. I don't even know if that's far enough out to make me comfortable, though, frankly. That's not worth it, though. That's tough. All right, you're going to get 10 for those, let's say. So $195. Well, that's silly. All right, tell me. All right, so you can sell the $200 puts for $11.30. You can sell the $500 calls for $13.50. So you're collecting 11 something plus $13.50, $26. So you collect $26. There shouldn't be a lot of margin in it because you're offsetting them, and they're miles out of the money, on both sides. Now I'm more worried about the put side than the call side because Tesla is not going to be worth double what GM is worth in 2 years. Not in 2 years, in 1 year. 1 year from now, Tesla is not going to gain an entire GM in value. I really have to say I super duper doubt that. So I'm pretty comfortable saying that's a good play. But I'm just pointing out it's like so stupid because their pricing is insane. Who is it? I wish they would introduce you to the people you do business with. Who is the person who's paying me $13.50 so that they can buy Tesla from me 1 year from now for $500 a share? They're like, Phil, I know Tesla is at 320 now and not even looking like it's in good shape, but I just want to lock it down next year for $500, and I'll pay you $13.50 if you promise you'll sell me the stock for $500. First of all, if it actually goes to 500, if it goes to 450, I could buy the frickin' stock. I already sold the call to cover it. I could probably buy some puts to protect myself with his money. So it's not that hard to fix if it goes wrong, if it goes badly on me. But again, this is assuming you can afford to buy hundreds of shares of a $500 stock, which is $50,000 per contract. But that would be my solution. I'd be like, okay, fine, so I'll sell you 10 shares, And if it happens, I have to buy $500,000 worth of Tesla as we get closer to the thing. It's very easy though. If it goes over 450, I buy the cover, and I've already sold these short calls for 500. And then if it goes under 450, I sell. And the only thing I have to worry about is it gapping down on me. And so if I'm only worried about it gapping down on me, I can sell puts that are fairly out of the money. And in fact, I already sold puts, didn't I? I sold these puts over here. I'm sorry, I buy puts. So I made some money. I make some money buying the puts. I'm protected. So like I said, I'm much more worried about the downside. But I don't want to own Tesla. Don't put Tesla to me for $190. I don't think it's worth $190. But it's a fun way to play because it's probably within a year there's still going to be. I don't even want to say it. I think they'll be at least over 150. And as long as they're over 150, this play is pretty salvageable. But it just shows you what you can do with even extremely wide options when people are trading a stock like that. Okay. Futures, T. Did we talk about T before? We talked about T, but I think there's a certain it's disruption. The industry is being disrupted. But the bottom line is you still need something. And AT&T has the broadband, and they have the Wi-Fi, and they have the wireless, and they have the cell. So you need one of those things. You can't leave them. I mean, in theory you can go satellite, but unless you're going to go satellite, you need to be connected. And that's going to be a growth industry down the road because your car needs to be connected, and your lawnmower is going to need to be connected, and your household robot's going to need to be connected, and your fridge is going to need to be connected so it can tell you what it needs. It's going to go on and on and on. So I don't think they're going to have less things. I think they're going to have more. In fact, Sony has these robot dogs coming out. They've already done the first generation a couple of years ago, but they now have the much better, newer generation of robot dogs, which is now like a Siri too. So you tell the dog, like, turn on the lights. The dog's like following you around the house. You're like, turn on the lights, or do this, or do that. So it's like a walking Alexa. And you can now it'll handle all your. It's like a butler dog. It like handles all your little household commands that you can tell the dog. It'll change the TV channel and take care of things for you. And of course, it doesn't. And at nighttime, it patrols for intruders. And for the kids, it barks and acts like a dog and plays with them. So it's also a babysitter. So I mean, and they're smart. Sony's smart. All these Japanese companies are very good at this. They understand because in Japan, they're experimenting on people now. They know what it takes to get people to adopt robots. They've got this weird robot that's like a seal that they give to old people. It's like a furry seal, and it's a robot, and it does stuff. It like reminds them to take their pills, and it tells them things and talks to them and so on and so forth. But it looks like a cuddly seal. Why? Because they did research and they found out that the old people like holding the cuddly seal thing. A furry seal, not like a toy seal, like a plush doll seal. I mean, in a million years, who would think that that's something people like? But they love it. So these dogs, apparently, though, for having the first household robot, the dog is a winner, more so than that Honda thing, which is like that little tiny robot that's cute. That though, in companies, though, that works. It's very extremely non-threatening. So many companies in Japan, you walk into the company, you agree to buy a robot. In fact, if you're a cool company, you've got to have a robot greeting people. That's the future. So, and therefore, meanwhile, my point was, not to get sidetracked on robots, my point is, you don't want your dog to die when it leaves the house, right? So there's another connection you've got to have. And your robot certainly better have a connection when it's out of the house. Yeah, I mean, your robot, your car, because you want your car to pick you up, it damn well needs a connection of its own, right? So if you want your car to come pick you up when you get out of the place you're visiting, and you press the button, your car's going to come and pick you up. That from wherever it parks itself, then you need the car to be online. So there will be more and more and more and more connected devices, and that's going to be more and more and more business for these guys. And I mean not just connected in the home, because connected in the home you deal with a router. But when that robot leaves the property with your kids, it can't die. So yes, you're going to pay your $10 a month to connect the dog. You're going to pay $10 a month to connect the car. You're going to pay $10 a month to connect the other things. That's what's going to happen. It's years away, but long term, it's still a growth story. That's still a strong business going forward. It's hard to see when it's not going to be. Thoughts on SunPower, if not in, should I get them? Yeah, I like SunPower. Where are they at? SunPower, all the solars are having problems because of Trump. They've stopped supporting the solar projects, so the money's not there, and a lot of people are reviewing and canceling projects and so on and so forth. But globally, you can't stop this. Solar is now cheaper than most other forms of energy, and it's getting cheaper, and SunPower will make a fortune. Don't forget, they make the chips. They're not really installers. They're making the chips to make the solar panel. So it's not like they're in the installation game. And that's so they're like the Intel for solar, basically. Good company. Will it hit X5? I don't think so. I think that lesson's been learned by people. Do I have an earnings plan CBI? No, I like CBI. Again, there's nothing in their earnings to justify this move. I mean, it's just people think infrastructure is coming back and there'll be better guidance, but there's no way to tell what they're going to actually say. I like CBI long term. I still would buy them at this price. This price was I was banging the table when it was down here. That price was stupid. But now they're at a price where I think they're about correctly priced, for the market. Going forward, I think they'll go up. But I'm saying right now, 16 is a fair price. 20 is getting a bit much. And I forget what we have, but CBI. Where are we? Oh, that's not the long-term portfolio. That makes more sense. Oh, that means 3% during the webinar. Very nice. The market's recovering. So what do we do here? We have an unbalanced, we have 30 short puts. We have a 750-15 spread. So we're in the money. That's a done deal. Did we adjust it? Nope. Another one with low expectations that was exceeded. Still good for a new trade as it's a net credit. Oh, it's still a net credit. Holy crap. On a $15,000 spread, it's an aggressive put sale. Wow. So I said that on Friday when we were reviewing it. It is still net credit. 8, yeah, look at that. 18.7 minus 9.8 minus 11.8 is a credit. It's still a credit. That's crazy. It's 100% in the money, and you can still get a credit on the spread. So, yeah, I still like that for sure. Wow. That's stunning. So it's a 2019 750-15 spread that's 100% in the money, and the $15 short puts. And it's a net credit, and you get back $750. Crazy. Oh, and yeah. Well, we oversold the puts by a little bit, by 50%. That's how you end up with the credit. I would probably do it even. You don't need to be greedy. I mean, you can do it even, and you'll pay a small amount, but still have a nice 750 spread. What a great trade that is! Holy cow! Thoughts on RB at this level? I don't know what this level is. Changes so fast. Charts. RB. Oh, look, it back up. We never looked at the R report. Oh, we got so many things on our agenda, don't we? Market fail. Oh, that's a nice shorting spot. That was a good place to short. 2,300 fail. Yep. Okay, and 15. Oh, not 15. Didn't make 15. That was a good failure spot. Oil poking back up. Look, it hit 50.70. Wow. That's crazy. All right. So, for whatever reason, I don't know why oil is recovering at this moment, and gasoline, if it goes back up here, again, this is probably straining the highs. So do I like them short? Yeah, I do like them short. I still think we're going to bottom out into early November. It's too far ahead of the holidays, and I don't know what demand is. But let's take a look. Now we'll see if we really like it, because we can look at the petroleum status report. And now what we want to see is, can we figure out why we had such a big draw in gas and oil? So distillates dropped 5 million barrels. Gasoline dropped. Wow, that's a lot. I mean, it's like 16 to 22. Yes, it's more than 5 million barrels there. And oil had a tiny build. So what happened? What did we do? Wow, look at that. Net imports. Net imports dropped by 500,000 barrels a day. So we exported. See, exports jumped up from 2.3 to 2.9. So that's 600,000 more barrels a day. So that's 42, right? So 4.2 million barrels of the drop was because we exported 4.2 million barrels of refined products. So half of the drop that people are saying is so amazing is because of that. Now, what the hell else happened though? Gasoline, the same supply. They cut back, the refineries cut back a little bit of production, but not significant. Distillates, same supply. All others, same supply. Overall, basically the same supply. So very little change there. So it's really mostly about the inputs. And then you have to say that there was a uptick in demand. But you always have to put these things in perspective also. So people overreact to these reports amazingly so, because we use, well, it's right there. We use 20 million barrels a day, 140 million barrels a week. And you're talking about plus or minus 5 million barrels. It's a tiny little amount. It's a quarter of a day. It's 6 hours worth of production or use. And it could be because a tanker went left instead of right and didn't get counted, or a lot of things could happen. It's not enough to move the needle. You want to look for the trend, but you also got to be very careful with this stuff, because this is a shuffle. This is 6 million barrels. Not 6 million, 600,000. 6 times 7, 4.2. 4 million barrels. So almost half of the net draw was because we sent it out of the country. It's not that there's more demand in this country. That's the key. The effect is half of what they think it is. And then you just got to look at the bigger picture and think where we were. So last week, here's weeks. Gasoline production was steady. The big story here is the exports. And believe me, most of these exports are gasoline being exported. And the distillate, that's a kind of a random thing, depends on what they're doing with it. Airlines, ships, so on and so forth. There's all kinds of reasons for why they'd be doing that. And also, by the way, a lot of the hurricane relief probably drained a lot of gasoline too, because it's like an army exercise. FEMA and all the other the National Guard and so on and so forth for the hurricanes. It's like an army thing. And the army, I know from the war in Iraq, was using about 1.5 million barrels of fuel per day. Because those things, those big trucks, now, this isn't as big of an operation, obviously, but the big trucks in the Army and things like that, they get it's how many gallons per mile they get. They'll use like a gallon or 2 gallons per mile when they're traveling. So they just chew through oil and gasoline. And that's a factor too. So there's probably legitimately a demand draw, but part of that demand draw is probably from unusual government activity. It doesn't mean that there's a trend. So again, it goes back to, so on the whole, I'm still comfortable saying that we could short oil here. In fact, let's do it and see what happens. So we'll check it next week. Because time frame wise, I don't mind being short oil. So that's going to be gasoline. Not oil. Short gasoline. So here's gasoline. We find the right spot, and I'm going to just click here. Whoop, nope, I'm going to click here. If it's rising, I'm not going to click at all, right? Why? Here, when you're about to do a contract, why would you do it while it's going up against you? Just watch it for a second, get a good spot. It goes back down, it goes back down. But I mean, meanwhile, maybe I can avoid taking an immediate loss. So now it's kind of stopping. So let's try right here, see if I get a fill. Whoa. Very good. There it is. That's my offer. I'm the only one who's offering to sell at that spot. Now 2 people, somebody else joined me. Only one person's offering to buy, and they're not budging. Oh, now it dropped. Somebody capitulated. And so if I click here, it'll fill that. So I want to see where the next move goes. Let's see, all the stocks are going down, so I don't think probably it's moving up on this thing. Oh, wait. So I'm killing that, and I guess I'll take it. 173. Oh no, see, waiting is good. Look at that. There you go. That was easy. All right, so now I want short. If it goes up to 175 or 176, I'll use this line. If it goes up to 176, I'll double down. Other than that, though, I'm not going to double down. I'm going to wait till next week. So my plan is to short again at 176. That would make my average 174.5. And then, of course, if it drops back from 176 to 174.5, I'll reduce my contract back to 1. So just speculating. We'll see what happens. Oh, and silver, I already have silver. Silver's back at 17. I like silver down here. I think I'm still in silver. I don't know, I took profits on a lot of stuff, but everything was making money. So if everything's making money, take it off the table and start again. Oh, here you go. I have 2 contracts. They're flat, so this is where I came in at 169, at 1695 basically. So I'm not going to add. 2 contracts is fine, and see what happens. All right, what else looks good? Obviously, silver's good. Gold is good. It's a matter of preference. But I actually like playing silver more than gold because the contract's a little more exciting. You get a real fat payoff. Here's gold, 12.78. So the dollar a bit low, but it's not playable. Oil I wouldn't touch. It's crazy. These guys are probably going lower. And coffee. Coffee's definitely playable down here. So coffee 127.7 is always good for a ride. You know, and again, I love playing things when I have a long-term premise. I probably have one of those left too. Maybe not though. This top, KCH8. You gotta be careful with coffee because it stops trading. Oh, and they stopped trading. Damn it. Oh well. So on the spike this morning, I sold the coffee because that's what happens. I mean, if it goes up, I came in around here, it went up, it started going down, it lost momentum, I get out and sell it, and now get in again. Because you know what? It always goes up and it always goes down. So you just got to pick the right time. So you look at the channel, you figure out your spot to enter, and you do it. And again, I like playing these things like that because of coffee, I'm long-term bullish. So whatever it goes down in the channel, I buy it, and then I wait. And if it goes further down, at least I know I believe in it, and I'm willing to add to the position. I don't like to buy things just because they're, because you think it's going to bounce, you think it's going to this. But if you don't have a long-term conviction in a direction, then it's really painful when it goes against you. All right. I have to wrap this up soon. BBBY, can you please give me an earnings range for 2017 and 2018 and what? Geez. Okay, so BBBY. What are we looking at? Wow, they got so cheap. Do we have them? Yeah, we do. Look at that. Wow, and they got killed. Well, don't ask me. I'm wrong. we have a bad position in those guys. What did we say Friday? Do we know about this? Oh yeah. So we did a roll. Okay, well that's what I think of Bed Bath & Beyond. Then I mean I think this is the bottom. I think they're again, it's an out of favor retail story. We reinvested. We rolled our $30 calls to the 2019 $20 calls, and we will sell the 2750 calls. Blah blah blah. What? I think I made 2020 here. I don't see why I would have done it with the 219. This should be 2020. Let's see, 2019 $20 calls. Nobody caught that. BBBY. All you smart people, somebody's got to proofread this stuff. $5. Yeah, these guys. They're $5. These guys aren't $5. So that's why. All right, so that makes more sense. So we did the 2020 spread of whatever it was. So we bought the $20 calls. We sold the 2750 calls. So that's our range. Is we're looking for 2750 into 2020. So we're looking for a 20% gain over the next 2 years. The $30 puts were 980, and we rolled to the 25 put. So basically, we're saying that we're very, very positive we're going to get back over 25, and we expect at least 2750, which is not hugely ambitious, but that's the range that we're looking for on the trade. And why? If we go to BBBY, and again, this is one of those stupidly priced things. They earn, this is crazy. Current year 2018. Oh, well, they got a weird, no, current quarter. How is 2018 the current year? That makes no sense. All right. So in 2018, they're going to make $3 a share, and they'll make $3 a share or thereabouts in 2019. Yet you can buy them for $21. The P is 7. That's how out of favor retail is. So, do I think the retail will get back in favor? No, I don't. I think if people are going to be down on retail for a while, I think it's going to have struggles. But at $21, when they're making $3 a share, I want to buy them. It's 15% interest on your money. Just because you don't get it back, just because they're not paying a dividend or whatever, they're earning. You own this company. You're buying a share of ownership in the company. You're buying it for $21, and in 2018 they're going to give you $3 back. Whether it comes back to you in the value of the stock, whether it comes back to you in retained earnings, whether it comes back to you as some kind of dividend or whatever, who knows? But the bottom line is your partnership made $3. It's sitting there somewhere in your thing. Those usually over time, those things true up and people start realizing the value. Usually. And I'm always willing to play those because, I mean, there's value there for sure. Those are the kind of stocks I love to play. Sold 35 puts last year, want to exit them. Some ideas of dragging down your portfolio. Well, they're not going to not drag down your portfolio just because you move them. So You sold the January 35 puts. They're $13, $15. Wow. Well, sure they are. So you sold the 35 puts. I don't know what you sold them for, but let's assume you're down at least $10. All right. So what you want to do is roll your loss. But you understand, you're not going to change your portfolio by doing this. You're only going to move it so that you won't have a current loss. So you're going to take this loss by doing that. You buy these guys back. This is rolling. And then you say, well, so what did you lose out of that? Let's say you lost $10. You want to try to make that up, not make up the whole thing. And here you can sell the 2250 puts for $550. And I would not try to be so brave. I think I would lean more towards selling the same amount of these. So basically, these are like $7, the 25 puts. So I would sell the 25 puts for $7 and see how that goes. So in other words, you're going to take the loss. You're going to net 8, right? You're going to take these for 15 or whatever they are. You're going to roll into these for 7. You're going to take 8 out of your pocket. So that 8 less whatever you collected up front, that's your loss. You're taking that loss. Now you're sitting on these guys for 7 that you hope will expire. But instead of 35, you're down to 22. And if it all works out, you should get the bulk of your money back without adding to your risk. And in fact, obviously lowering your risk, because even if you do get it signed, it's at 20-something instead of 30-something, instead of 35. So that's the way I would fix it. And again, not huge confidence. I think Best Buy is a great value and so on, but I don't think you should have so much eggs in a basket like that. It's a lot. So instead of doubling up there, you're better off diversifying and selling puts in something else, like maybe the overall XRT if you want to stick in retail, or maybe Macy's, or maybe limited brand LB, which I am banging the table on. How are they doing? LB 40. They're getting away from me. Damn it. LB is my stock. Well, LB is my top choice for stock of the year, but I don't make my stock of the year pick until Thanksgiving. And if it's too high, I can't use it for my stock of the year. That's what happened with IBM. Pissed me off. I shouldn't look. That's why. See, I shouldn't even think about stock of the year until Thanksgiving, because then I get angry. At 35, I was, I was telling everybody LB. People were getting sick of me saying LB. So now it's at 45. I'm like, I don't want to. I hate to recommend it here. Still love it though. And it's another one with stupid prices. So you can actually. Where are we at here? This is 2020. So you can sell the 2020 $35 puts. Well, forget that. The 3250 puts, $5. At least definitely $5, more like $5.50. You can sell the 3250 puts for $5.50. That nets you in for like $27. It's at 44 now. They'll pay you $5 to buy it for half price. So that's what I would do instead of going whole hog on one retailer. I would spread it, and definitely I would spread some over here, because that's phenomenal. Yeah, and they were talking like Victoria's Secret, and it's pretty iconic, I think. Just a note on your chart, your CLX7 keys, the pricing is expired. Oh, thanks. That's just because where it was saved from last time we did this. I think it was weird rollover back then. Oh, but that's why it looks weird. Okay, yeah, I see. Because I was looking at that. There you go. That makes more sense. Okay, good. Yeah, it's important to have a live chart up instead of a dead chart from last session. Yeah, I need guys. See, I need editors. I need oversight. SEO. short. We're short the November 17, 35 put. You still believe we're short? You still believe this is a good play? Short November 35 puts on SCO. Is that an official play? I think I forgot to log that somewhere. November. Oh, yeah. It's an ultra. So basically we're just saying oil is going to be a little bit lower into the middle of November. Yeah, absolutely. I like that one. And if not, I'm happy to roll it because, even though we expect to spike up into the holidays, so maybe it'll go a bit lower, look at SCO long term. I mean, well, this is a bad example. It bottomed out here at 25, but then it shot right back up. It bottoms out. It always shoots back up. So if you don't catch it here, just wait a couple of months and you'll get it. So that's why I like that one. It's like you can always stick with it. The current contract last day is Monday. Of what, oil? Already? No. What are you talking about? Oh, that's the keyboard. Monday. I don't know what contract means. You say something before, right? Oh, wait. Any new futures? Okay, I'm not sure which one we were talking about. Is it gasoline? I'm not sure. All right. If it's gasoline, then yeah, we'd have to hold over the weekend, and if it doesn't work out, we'll roll it. Yeah, RB, okay. So so in other words, the December contract expires on Monday? Interesting. Okay. So if it doesn't work out by Monday, then we'll have to roll it to the next week. But otherwise, so that's to the next contract. But I didn't think it expires, I think. Well, I'll tell you in a second. Let's make sure. RBX. No, 33 days. Well, I guess it depends on what we're tracking here. So what do we have? RBX. Oh, shit. Okay. Yeah, you're right. No, we want to be in the RBZs, not the RBXs. So let's take that back. That's actually not good. Thanks for that. That's a good catch. RBX7. That's why you're confusing us. It wasn't December. We went into the wrong contract. And we want to be in RBV7. That's December. And I thought we were defaulting to December, and we're not. Wow, look at the difference. So already nobody thinks that 170 is going to hold, but unfortunately, in one day it could easily hold. So what I'm going to do is I go like this. So I've transferred my contract over, and now there's my break even. So I want to buy this one back and hope it fills. And if it doesn't fill, I don't mind being double short into tomorrow. I just have to remember that I can take one of these guys off. Well, obviously, I can take that one off. So now I'm double short into tomorrow on each contract, and I'm trying to get out of this one even at where I entered it. But that's how you flip contracts. When you want to roll, that's all you do. You just put them next to each other and make sure. I do it one by one. I mean, I'm going to make sure I sell here at the price I want, then I'm going to go over here and do it. Unless you're really thinking it's going to make a move and you try and time it. But that was easy. It's very easy. You set up a short here, take a short away from there. Set up a short here, take a short away from there. That's how you do your roll. And it's great on futures because it's so frictionless. Yeah, it's weird how much less it is, right? So everybody's expecting a drop, basically, already. All right, I think we're going to wrap this up. I know I'm tired of talking. Wow, 3:07, we have to wrap this up. Ooh, I filled. Ha-ha! Look at that. See? Ask for your price. Very important. Don't accept the price just because it's up there. Don't chase it. You say, I'm willing to do this. Go put it where you want it, and then wait. Be a little bit patient. It can't, it can. I mean, it can kill you, but it's not going to kill you most likely. It's just going to be, you might lose a little, make a little. But the point is, why offer? Why capitulate in your first offer? I put it down where I would break even, so that way I break even. I'm done. Cost me $1 or whatever for the transaction fee. But I want to get out even. I don't want to get out with a loss. And here, I just, I came in right there. So I knew when I did it, I lined up here, and I'm out here. And now any movement now is transferred over to this one. All right. Thank you, Robbie. Appreciate that. And that'll be it for today, I think. It's bothering me like there's something I wanted to talk about, but I forgot. But I have to wrap this up for time. All right, nope. That's the big one we're going to carry in, and the other one was long silver for sure at $16.95, and natural gas at $127.50. This is the HA contract on natural gas, so that goes into like March of next year. March, yeah. So that's March of next year on natural gas. And I like the March shift because natural gas is very prone to weird dips and things. So I might not want to just suddenly get in or double down. So I could rather just leave it alone, wait, and see what happens if it goes against me. But again, this is a 2-cent winner. You make 2 cents on this thing. It's a few $100. Take the money, wait for the next dip, and take that. That's all. I'd rather make $200 10 times than sit around waiting to make $2,000 once. There you go. That's my thought for the day, okay? Today's wisdom. Make $200 10 times. Don't wait to make $2,000 once. All right? Thanks for coming, everybody. Talk to you next week.